right, here goes. I'm Jim Cleaver. This is Finance 3025, Colorado Mountain College School of Business, 9:44 on July 24th. We're 8 weeks in, a 10-week course, and I know you want to look at some homework, so I'm going to put some homework up for you, and check figures, etc., on these Excel problems that I've taken from Cengage with some solutions or stuff. As you can see, I'm in my bunker here. This is my little office in Glenwood Springs. If you ever want to come and schedule some office hours, you're welcome to do that and come here and look at what I'm up to. 5 point right there, right there. Right there, it's over there. There's a TV on with CNBC. I'm my trading platform is running here. I use Charlie Schwab. In case you're curious, I just got off the phone with my dad, who's my partner, been my partner for a long time. Taught me everything I know. I mean, everything. Like how to go to the bathroom on the toilet. My mom did too. I shouldn't say that. She was the greatest. And but this is order flow here down here. Right? These are trades over here, and this is bid and ask, and you can watch the tape. Back in the olden days, let's see that picture over there. That sketch behind my ear is of the New York Stock Exchange, where my father used to say he could watch momentum just by watching the room. And he was the auctioneer there. In those days, they call it a specialist. If you're curious about all these things, I think it's 331, which is markets and institutions. You'll learn about the open outcry model. This is an electronic model. These are options on what's called the Qs, which is an ETF, an exchange traded fund, and you can see bid and ask on all different options here, and what they would cost. And what I would do here in the morning is click. You can see where I traded this morning. It was these two candles. And you click on them and you would buy and sell those options. And count on a price movement. You see that's at the $1.09 here, $1.07, $1.06. It's going down, right? So maybe the calls are going up. There's a 375 call to $1.70, $1.20. I'm sorry, $1.21. Bid offered at $1.25. So there's a spread there. Now it's at 25, 26, 27. That means that the stock itself moved me out of the way. It's probably moving up. And I can show you that real time here. This is the Qs in real time I have supply and demand zones here. This is a hole in the chart, a historical hole in the chart that might want to be filled. But you can see how this candle is moving up and down. So enough said about that. I know that's not why you're here. But if you're curious about trading and that sort of thing, take my courses. It's a little plug for me. So, and by the way, next door is Zumba, which I love about this place. If you can hear that music going, the ladies are over there. And I keep threatening like I'm going to go over there because if you've seen me live, you know I'm a little overweight. I should be over there. It's the timing is wrong because I need to be here right now. Anyhow, all right. So let's go to. Here's my Excel sheet, but is that coming up? Yes. Hooray! I made an earlier tape where I screwed this up because I didn't have this is OBS software and I didn't have it set up right, but I'm figuring it out. So here's our assignments. The first one I want to go over is cash flow and taxes, I think is one I have up here. Comprehensive, this is chapter 3, spreadsheet problem 3 here, and I'll make it bigger so that you can see it. Is that too big? I'm not sure. Yeah, that looks good. So there it is. chapter problems 3 through 19. Leho Industries. Your numbers are different, I'm sure, but as you can see from this, sales for 2021 were 455, 150. EBITDA was 15% of sales. So there's your hint there. Depreciation and amortization were 18% of fixed assets. Interest was 8,583,000, right? And so here's the key input. You see how they did this, and you can mimic this. Again, I want you to go through these problems in order to learn the stuff. I think that learning happens, any way you get to it, and whether or not you get the figures and then come back to the method and that. I urge you to combine looking at this homework. If you could put another screen up with the book on it and sort of look through the book while you're doing it, it'll probably help a lot. So here's found after finding EBITDA, found this first, right? That why? Well, that was the key to everything else. So that hint is handy. So, and then down here in B, construct a statement of the stockholders' equity for the year ending, right? And so we had that common stock issue. Don't forget that. And that's all up here in the problem. Right, construct the firm's 2021 income statement. Well, there's that. Sales, expenses, depreciation, amortization, interest. Not much, not a very robust. And again, if you're having trouble with accounting, I suggest you take it. But of course, accounting's a trade, and you can do it online through YouTube very quickly if that's what you decide to do. To get that kind of, I think it's great to do it in class. I think it's one of those courses that it's great to do in class because the rote memorization, and it's a team sport. Now, the other thing I want to do here is to show formulas so that you see those formulas that are embedded in this problem. Here they are here, right? You see this show formulas tab up here. When you do that, when you do the problem, you can do that and see where they're getting the data, right? CapEx, net operating working capital is here, 116 minus 111. Let me go back here and show this part. C. Let's go. I don't know how far I went. C. There was B. Construct a statement of stockholders' equity, right? And then here's the cash flows. Net operating working capital here. Again, here's the formulas in case you were curious, and you should be. And then D, if they increase their dividend payout ratio, what effect would this have on the corporate taxes paid? What would this have on the taxes paid by company shareholders, right? Corporate taxes are pass-through taxes. Increase the firm's dividend payout ratio with no effect on corporate taxes because dividends are paid in after-tax dollars. But the shareholders pay additional taxes. They're pass-through taxes. And by the way, just from a libertarian standpoint, which is obviously my bias, there's no such thing as corporate taxes. You pay them. That's now you can tell me you're a Rousseauian or a Rawlsian, and that corporations don't pass those taxes on and increase prices. I doubt it. I don't believe it. I think that analysis is flawed, and we can have healthy disagreement on that. That's a debate to be had. Assume the firm's after-tax cost of capital is 10.5. What's their EVA? EVA here, right? And let's look at these. Look at these. All right, and there they are. After tax cost of capital, total invested capital, economic value added. Assume the firm's stock price $22 a share. At year-end 2021, it got 10 million shares outstanding. Right, what is there? MVA. So, you had to go to EVA, MVA. It's a good time to go, oh, well, what does the book say about, let's see, EVA? You can do that, right? You just search it. And it should bring it right up. MVA, yeah, I just reflect market value added and economic value added. And you can go, refresh your memory on those things. It's just a jargon. It's like me learning Spanish. It's linguistic. It's like, damn, I see all these, and you've seen me get confused in class. There's so many acronyms. It's just endless. And I don't use them every day, so getting familiar with them is part of your education. Learning a new language. It's the language of business. All right, so hopefully that covers chapter 3. Let's go through and hit chapter 4. That's this problem here. And I'm looking over at the market because I'm curious. There's the cues. And see, if I was going to draw a line here, I would. It looks like kind of a down day, like it's going to run that. But they're up 28, 21. The Dow up 196. So far I'm wrong. All right, let's see if we've got this open. Make that bigger so y'all can see it. Here's a spreadsheet problem. And Corrigan Corp, problem 4-25. December 31st balance sheet. Here they are. Income statement here. Once we have the information, we can calculate the necessary ratios. And this is just a matter of knowing the ratios. And let's see, where's our formula? Right, so current ratio, D12 minus D22. When we go back to ABCD, D12 current assets, the sum of D9 and D11. It's going to tell you these ratios right off the bat. And right, so that's pretty self-explanatory. I hope, especially if you've taken 121, 122 accounting, you should be okay with these. Debt to capital, price to earnings. So we have A, B, C, D. Where are those? Measured short-term, long-term debt. So this is some of the information you need to answer the question. A, assess Corrigan's liquidity. How are they? Improved from 2021. Current ratio still below industry average of 2.7. Good answer, right? Simple. Assess Corrigan's debt management position. I'm just checking to see if I'm recording. Is that funny? Like, duh. Is it nothing worse than making a recording and then going back and going, nothing happened? Assess Corrigan's debt management position, how it compares with peers. Who are peers? Well, comps, you might call comparables. Debt to capital ratio increased. Its debt to capital ratio was slightly better than industry average, but in 2020 it was worse in industry. Given a weak current and asset management ratios, the firm should strengthen its balance sheet by paying down interest-bearing debt. Right? Pay down debt if you can. Always pay down debt if you can. That's the idea. And later on, we get into leverage. And I've gone down that rabbit hole with in our lectures in class, where I say debt is not good. Anyway, I don't want to go there today. Market value ratios, D&E, profitability ratios, calculate their return on equity. Let me show you those formulas there to give you an idea of those. So you run through this, and this will be on YouTube. You can stop the tape. Looking for the DuPont equation. What the hell's the DuPont equation? Obviously, DuPont is a chemical company. Corrigan's profit margin is slightly lower than the industry average. If you didn't look up the DuPont ratio, it's in the methodology. It's in the book, which is good. Again, easy search, right? DuPont equations here. And you can just click on it, and it'll come up for you. This is how to do your final exam too, by the way, with your search box. And that's how you learn. The game is over. You can do this on ChatGPT if you want. My day of rote memorization, I think, is over. Liquidity asset management. Here we have the DuPont equation. ROE equals profit margin, total asset turnover times equity multiplier. So you can see the subjectivity in it. However, it is a good tool. So there's that. What do you think would happen to the ratio if they started cutting costs? A lot of lower levels of inventory substantially decreased cost of goods sold. So if you lowered inventory and COGS, what would happen? It would increase net income, improve profitability ratios. That's at getting to know how the statements, the financial statements, relate to one another, and how an analyst, whether the analyst is internal or external, might look at those. So and that's what you're in a finance class like this. You're trying to run those scenarios internally and say, well, here's what I think. You're the CFO, right? So you're saying, oh, here's what I think. Here's what I think may happen. Given the macro environment, and if we pay down some debt and we do some cost cutting, what can happen? Certainly, one of the boards I sit on, we're talking about that very, very closely. And the CEO is right, laser focused on that, which is wonderful. But I always have to mention, that cost cutting isn't the be all and the end all either. I mean, there's despite my libertarian leanings, there's moral issues. I like taking care of my employees, so there's that. I always said to myself when I was farming, if I couldn't pay my employees well, I wasn't going to do it. Okay, so that is chapter 4. Let's head for chapter 5. I think there's a chapter 5 problem here. And this one, they're nailing it over there. It's good we have accompanying music. Solution to end of chapter comprehensive. This is chapter problem 5.1. If you look in your homework, and I go over here, chapter 5 is time value of money. Right. So here we go. Essential, again, we start out in accounting, like the first year of accounting. If we can get you to understand the time value of money and interest rates and net present value of future cash flows and projections like that, uh, you've gone a long way towards what is a business education, in my view. And those are the basics. Everything sort of builds on there. So here's present value formulas and inputs. Find the future value of $1,000 invested to earn 10% after 5 years. The miracle of compound interest. So here's how it's done. Let's go to formulas and show what that looked like on this Excel sheet. When you use Wizard to fill out the result formula, see on the formula line is the pointer and cell E13. Experiment. Now create a table. Here's the table. There's the formulas for the table. Pretty simple. Gone are the days where you got to go to the back of the book and look at these tables, real tables that have been worked out. I think you've seen them. If I go in here and I go out, and just look at images. It used to be like this. You had to go in here and look and find present value table. Here's the formula, and you're going. Here's the interest rate right over here, and here's the periods. How many periods? 15 years at 5%. So if you had $1 million and you wanted to go back, let's go back 30 years. What would you need to start with? 0.0994 of a million, or 0.0994. If I did, I'm grabbing my handy calculator here. $1 million times 0.0994. So what do I need in 1970 to have $1 million in the year 2000? I need $99,400. So $99,400 will turn into $1 million in 30 years. Get it at 8% in my little example. So that's how you did it in the olden days. Discount rate, right? But now we have this wonderful, Excel spreadsheet that just does it. So create a graph. And if you don't know how to create a graph, it's a great time. Insert scatter, follow the menu. It's easy to make a chart. If you're not curious how to make a graph and you're not on the team yet, with that, go to YouTube and go make a graph. You can see what I'm up to in my how to make a line graph. So many people that want to help you do that. So just click on one of those and get an idea of how to do it. Once you know it, it's really handy for all your papers and stuff like that. You copy and paste it into Word and all that kind of stuff. Anyhow, let's show the formulas. There, right? Find a PV of 1,000. And Wizards menu here. Use 0 for payment because there's no periodic payment. Also, the new future value is a negative sign, so it'll appear as a positive number. There's the hints. Excuse me. Right, 2,000 after 5 years. There's that. And I can show those formulas. And ordinary annuity, right? And you can look up annuities and things like that. These financial instruments to get your vocabulary going. And there they are. bunch of problems there to get you going. I don't think they're too brutal. Gratefully, I think this is reasonably. I chose these because they're quicker than the homeworks. The homeworks look brutal to me for a summer course. Excel doesn't have a function of sum of future values, uneven payments. So the easiest procedure is simply compound each payment and then sum them. All right, so that works. All right, a lot of stuff I understand. And then lastly, they wanted to create a graph doing a breakdown of payments, principal and interest. So you can see how the interest dwindles and the principal. I think I showed you, in Excel how this works in class. So that is chapter 5. Boom. And I'm going to try and keep this under an hour. Let's see, I'm 26 in, so I'll go another half an hour. We'll get a good ways along, and then I'll make another one. I think an hour is about what you can take in one of these. And it takes a long time. I'm a YouTube guy, and I want to download them on there. Okay, now chapter 6, right? Interest rates, 4 or 5, time value of money, interest rate determination, yield curves, right? Let's do that one. Go back to my Excel sheet. I'm just take a look at what's going on in the world, just for fun. There's the Q's, made kind of a top here. This is supply and demand, this dotted line. So it hit that line and it bounced off it. They're up 34 from 50. So not much going on. It's the dog days of summer. We call them that. And that kind of makes trading very light and in a light market anyway. All right, here's chapter 6. And of course, chapter 6 involves interest rate determination and yield curves. And we can do this interest rate chapter 6, 6, boom. Interest rates, very important, right? And so crucial to everything we do in the business arena. What are the price of money? The way the Austrian economist looks at it, it's the price of money. Money being a commodity, it's supposed to be. What effect would each of the following events likely have on nominal interest rates? Let's give you some quick answers there. Suppose you're considering 2 possible investment opportunities: T-bond and a 7-year A-rated corporate bond, right? But you've got default risk on a corporation. Supposedly, the government will never go out of business. Not sure that's true, but we're acting as if it's certainly priced into the risk-free rate. Now let's look at these formulas for you. Here they are. All right. Oh, excuse me. Next 2 years. It's giving you inflation expectations, and of course, where are we? I don't know, 5, 7, something like that. I don't think it's going to go straight down. There's a lot of You talk about Goldilocks and this and that, and soft landings and things in the macroeconomic genre, and the field genre, yeah. But I'm skeptical. I think that inflation is going to be tougher than that because I have some experience, right, in the 80s and whatnot. So maturity risk premiums. Treasury yields. Did I show you these formulas? I think I did. And here's the 7-year bond right here. Um, here's how that looks. And look at all that, huh? So if I show these formulas here, you can see these. These go with this. Inflation, maturity risk, 12-year treasury yield. And then down here we have the corporate bond as a comparison of these two different investments. Default premium could be determined using a VLOOKUP function, right? It's got you some hints here, stuff that'll be helpful for how you approach the problem. Construct a graph of the yield curve. There it is, right? And the yields involved. All right, pretty simple, I think. I don't mean to be dismissive of the, this is not easy. Based on the information, corporate bond provided in B, calculate yields and construct a new yield curve. Shows both the treasury and the corporate. Right? What's the difference between these two? Well, default risk. This is the risk-free rate and default risk and inflation. The higher the rating, the lower the curve should be, right? If it's a great bond, it'll get closer and closer to risk-free. That's psychological, if you will, but real. Good stuff. And then down here, which part of the yield curve, left or right, is likely to be more volatile? Of course, the left side, because of time. Time is something you get to. So if you're like philosophically to think about time, well, the business school urges you to think about time. It's not just something to sit around and drink wine and think if it really exists. Using the treasury yield information, calculate the following rates using geometric average. Right, and here's the formulas I can show them here. Here they are. Excuse me. And that gives it to you. 1-year rate, 5-year rate, 10-year rate, 20-year rate. Ta-da. So that's chapter 6. Let's move on to chapter 7. And again, here we are. Comprehensive spreadsheet problem that I put in there. It is talking about interest rate bond valuations. If you're clicking through, I should click through and show it to you. If you're so you click through here and it brings it up in Mind Tap. Here's what it looks like to me. And you click on this bond valuation spreadsheet and it'll bring it up. You put them aside. when John and I were working in the classroom, I bring them up side by side, and or he can steal my screen and do that. So if you want to do some of that, we can do that too. Clifford Clark, recent retiree. He wants to be in corporate bonds. Here's bond A, bond B, bond C. Calculate the current yield for each of the 3 bonds. Well, what is he looking for, though, in a general sense? What this man or woman, they're why are they looking into fixed income? Well, it's safe, and not only that, why do they want yield? Well, if they're retiring, they need money to live off of, and you don't want to spend your principal. You like to keep your principal. Maybe you have some children and you're interested in leaving it to them, or which my father and mother have been kind enough to do, but or you're just you don't want to spend down principal because you want to give it away at the end of your life to, charitably. Um, but planning to pay to live off the principal is very difficult too, because no one knows how long they're going to live, and a lot of people in the that I've met have run into trouble that way. Geez, I outlived my plan. You don't want to do that. There's the basic inputs. Current yield for each bond looks like this, and of course comes at 8, 9.5%. They're awesome bonds. Yield to maturity remains at 9. Will the price of each bond 1 year from now? Projected price. And here's the formulas there, and how it works out. 999. He's considering another bond D, 8% semi-annual, 1,000 face. How does that one work out? 5.83. And that 5.26 nominal. Is this a muni bond? Because municipal, the reason I bring that up is you may get less yields here, but there's no taxes on municipal bonds, where there is on corporate bonds. Interest rates have declined. Yes. Explain briefly the difference between price risk and reinvestment risk. Which of the following bonds has the most price risk? And there's those formulas. Price risk of decline, the bond's price due to an increase in interest rates. Reinvestment is the risk of decline in interest rates will lead to a decline in income from bond portfolio. You can read that and take what you want. Excuse me, I'm gonna wet my whistle. And then G, only do this part if you're using a spreadsheet, which you are. And you can see how those. And when you click on these, it'll show you where they got the data. If you understand Excel, I urge you to take an Excel course. I did. I could use another one, honestly. I'm rusty, and they continue to improve Excel. I mean, just a plethora of new stuff in it is what although I live in my niche, I live in my world, my own little world. We all live in our own little world, don't we? What is the expected interest yield for each bond here? What are the capital gain? What is the expected capital gain yield? What's the total return? And that's all of it. Just show these just for fun, and show these. You can stop the tape. Boom. Looking good, I hope. Bond yields, again, it's one of those subjects that we hammer away at in the business school with good reason. If you can understand bond yields, you will be amongst a very elite group of people. If you understand that relationship with, in pricing and things like that. So I urge you to do that. It's bonds and their valuation. Rates of return is next. If you look here, the Qs sort of did what I thought it might do and dropped down through that. We'll see what happens here. Now, next one, chapter 8, right? So chapter 8, risk and rates of return. Here it is, risk and return. I'm going to make that bigger. Comprehensive problem for chapter 8 looks like this, Bartman Industries. All right. Reynolds Inc. stock prices and dividends along with the Winslow 500 index, 2015 to 2020. They use the data to calculate annual rates of return, right? Seeking alpha, rate of return to my investment. Everybody, this is what we sort of argue about. My father and I argue, but debate. Can people? People are chasing yield. They need a rate of return. That's why money keeps pouring into the stock market, and foolishly or not. It's not for me to decide. But it keeps going there. Here we are with the formulas for that. It added one. But this is all, you can look up here for formulas too, and but this is all given. This here is where we get into some of these formulas. Now, okay, the rates of return for the two companies and the index. So Reynolds didn't do great. To get the average, you could get the column sum and divide by 5, but you can also use the function wizard fx. Click the formulas tab, etc. It shows you how to do it. And then we get into standard deviation, which I discussed in class. I hope I covered it well. If you're having trouble with that, standard deviation, explained simply, right? That's right. Here's how to. There's so much out there to get you to, understand this stuff. Amount that scores deviate from the mean. Very, very simple there. So Bartman 31%, Reynolds 9%. Coefficient of variation looks at another formula, and here's where you can show them. Here's how they did it here. Look, they used the formula here, standard deviation. They used from the formula bar, which you can get that coefficient of variation there too. It's not difficult. And finally, the Sharpe ratio. And once more, if you're not kind of plugged into the book, you might want to be and say, Sharpe ratio. What the hell is that? Why would Sharpe ratio? What the hell, right? Sharpe ratio, a measure of standalone risk that compares the asset's realized excess return to its standard deviation over a specific period. Well, can I get my head around that? And I just look up risk and return and find all these capital asset pricing model, all this stuff. Evaluating risk and return, chapter 8. You just click away and find what helps you. So, stock returns versus the index. Well, Reynolds didn't do great, but we knew that. Here's how they got there. Right. Here's the how to do it. And you look, if you double click on this format chart comes here, and here's chart elements, data, no, styles and colors, but it'll show you how to do it. You open up the chart and add data and all that kind of stuff. So it's good to familiarize yourself with that. So estimate Bartman's and Reynolds betas by running regressions. How do we run a regression? Well, here's the regression stats. How did they get there? And here's the formulas involved. Right. Regressions, so their beta is at B128 right here. Residual output and summary output here. For Reynolds, and market risk plus risk-free rate times the beta gets you the required return. And what do we say here? This suggests Reynolds stock is like an insurance policy. Low expected return will pay off in the event of a market decline. It's counterintuitive. What if you formed a portfolio that consisted of half Bateman, half Reynolds? What would their beta be, and what would the return be? And then it shows it here, which is not out of the it's you're hedging, so there's a hedge fund involved. That's how hedge funds got their start. Like we're going to hedge. Hedge means insurance. Insurance against a market decline. You're trying to balance a portfolio so that in the event of a decline in the market, your client or you is covered. You're minimizing your losses. So here's the final question. All right, portfolio weight. There's, how would we weigh these? Stocks A, B, and C are currently, and their betas are this. Calculate the new portfolio's required return. If it consists of 25% Bartman, 15% stock A, and 40% stock B, etc. And it gives you how to do that. All right, that's 8. I think we'll try one more chapter. I'm like 40-something minutes in, 50 minutes in, so we'll try to get one more in here. Chapter 9, and then maybe 10. Let's see. Then I'll put the rest up later on. Enable editing here. So in chapter 9, what are we doing? stocks and their valuations, and the assignment here, interest rates, risk of return, corporate valuation, bonds. Boom, boom, boom. Research, I got some cool stuff here, but I don't see it. Well, anyway, let's get at it. I don't waste my time. Chapter 9, solution, end of chapter. TOSIG Technologies, TTC has been growing at 20% a year. The same growth rate expected to last another year, and then declined to 6%, which would be more toward regression towards the mean, the average type of thing. Right? What are the expected dividend? Dividends zero is $1.60, and 10%. What did TT stocks worth today? And here's how to calculate that. And let me put this formulas up. Right. Short run G for years, long run G for 3 years. There's the answer, 54.10. Should be the stock. Something like that. And is it, that's where you're looking for arbitrage. You're looking, oh, well, I calculated the stock at 54.10 and the stock's at 35. I think it has growth potential, so I'm going to buy the stock. Dividend yield, expected annual dividend by price at the beginning of the period. Right, so 192 divided by 54.1091 gives you 3.5 for dividend yield. Capital gains yield, subtracted dividend yield from the expected total return. That gives you your capital gain yield. Alternatively, excuse me, terrible. We can recognize the capital gains yield measures capital appreciation, hence solve the price in 1 year. Oops. Don't want that one. Okay. Solve for the price. And we have this. Recently introduced a new line of products that have been wildly successful. Free cash flows. After the 10th year, we'll grow at a constant rate. And that's the end of the problem. But here's the formulas here to show you just exactly how they came up with this. Look at that, baby. Wow, right? Isn't Excel cool? Using discounted dividend model, which we discussed a little bit. Ooh, isn't that all that coffee? The price is estimated by the corporate valuation method differs from the discounted dividends method because different assumptions. And it's interesting, right? So present value, the present value of future cash flows. There it is again, right? We need to understand these concepts of the time value of money and present value over and over. All right, let's try chapter 9 and we'll call it chapter 9. Boop. Let's see now. Here. And I just did 9. Chapter 10. Right? And the chapter, and this is going to be let's make this bigger. Okay, and chapter 10 in our book. Oops. Chapter 10 in our book is the cost of capital. All right, so when I go in here, I'm looking corporate valuation, risk and return, WACC, project risk, budgeting, weighted average cost of capital is what we'll be looking at. And here it is. So, condensed balance sheet for Sky. What does that mean? There's no, what are those? These are givens. Oh no, they're not all givens. They're close to being that. Accounts payable and accruals, all this stuff in here. Sky's earnings per share with 320. Let me go back to this. Was 210. The flotation cost 10%. Flotation cost, remember, is what it costs to pay the underwriters, etc. to issue the stock, to help you issue the stock. Security analysts are projecting common dividend will grow at 9%. Well, here's our input data. No formulas there. So cost of debt, cost of preferred stock, and then there's a calculation for CAPM. A, B, C, D. I can make it smaller and fit it all in, I suppose, like that, or I can, so you get the whole picture. Well, maybe that's how I should do it, but I like making it big so you can see it. Right, and there's how that goes. If you're playing along at home, CAPM, capital asset pricing model. I'll find the difference between R and RS and determine if the dividend method is the way to go. That's determined by the DC and add the differential to the CAPM model. See what your real return is. And I can show this. Right, there's the differential. If Sky continues to use the same market value capital structure, what's the firm's working weighted average cost of capital, assuming that it uses retained earnings for equity. So here's retained earnings for equity methodology here. And here's the calculations of those two. Using retained earnings or common stock. All right. Now, I think that's enough for one tape. Yeah, my 58 minutes is perfect. So I hope that's helped. Reach out if you have any other problems, and we'll go through them one by one and try and get you as much knowledge as you can in a summer course and get you out of here understanding some stuff about finance. And as I said, use, if I don't ring your bell, get on YouTube and find people that use it, that do. Damadarian is one of them. He's sort of my mentor in this. He doesn't know it. He really has a great Aswath, right? I don't know how many years with I can't carry his book bag. He how many years with NYU. His website is fabulous. What a giver. I think we think alike. That's why I like him so much. I look at him, but here's his YouTube channel, and goes right to it. And he's got a number of podcasts and things like that on there. But he's been doing it a long time, and he's got a lot of followers because he's a brilliant guy, and he can show you in his videos. A lot of this stuff is in here to help you. And so, I mean, you could search it for like future value or something. Something valuation theme, future of entertainment. Oh, that's nice. Time value of money. Look at that. Session 6. Financial statements. Right. His courses are up here. So again, if you find my performance lacking, hey, this is your education. It's not. I don't have a monopoly on this. It's not mine. And I certainly I've been educated by a number of people. So I don't have the monopoly on finance. I know a few things, maybe that Aswath doesn't, but I have a different background. I come from capital markets, so I think a good, robust look at that. But again, he's not the only guy in town. If you have trouble understanding him or whatever, he can. You can find other people who are teaching this very course. Intro to finance. So off you go. I'm going to stop it there. Thanks for watching. Subscribe. Whatever. I don't even know what they say at the end of these because I don't care. Subscribe. Give me a thumbs up now. See ya.